Well, it's 3:30 sharp here on the West Coast, 6:30 on the East Coast. Let's go ahead and get started. Let's get going. Welcome to the followmetrades.com webinar where I'm going to talk about the benefits and risks of trading with options. My name is Dean Jenkins and I'm the founder of followmetrades.com. And I'm so glad to have you all here. Thanks for showing up. I'm looking forward to this. I have been. I like trading options. If I have a choice between an option trade and just a plain stock trade, I'll take the option trade every time. And I think as we get into this, maybe you'll be able to see why. So as we go through, I'm going to go through this pretty fast. We're going to cover quite a bit of material, but I want to make good use of your time. But if you have questions, be sure and jump right in. Type the questions in, and just to make sure you can find that questions box. Go ahead and just type in where you're calling in from, what city, state, country. Let's just make sure you can use that, and it's always fun to see where people are at. And then we are recording this, and I'll be sending out a link to everybody who registered. So, if it went a little fast, you had questions, you can look back at it. And in that same email, when we send out the link for the recording, I'll send you a PDF of the presentation as well. So you can just look back at it quickly if you like. Okay, we got Boston, South Jersey, California, Hollister. Hey, Roger. All right, good, good. We still got people filling into the rooms, logging in and whatnot. Welcome to everybody coming that's here. All right, Gunner, Granada Hills. All right, glad to have you here, Gunner. You're a regular at most of our webinars. Good to have you here. Okay, looks like most people are able to find that questions box and be able to type things in. So awesome. Let's go ahead and jump in here. So here's what I'm going to cover today in this webinar. We're going to cover just the basic, very basic concepts of options, how they work. Some people already know this material, but I said I wanted to cover that, and some people don't, so we'll just go through it pretty quickly. We're going to talk about the incredible power of options and the profit potential or the leverage that they provide. Talk about the risk, because there are risks. We're going to talk about how to control those risks. And we're going to look at option chains and a little bit about how to interpret those, and then some suggested next steps that you could take if you're kind of excited about options after we dig into it a little bit. Be thinking, so I'm going to look at a couple live charts and a live option chain. So when we get to that point, be thinking of if you got some stocks you'd like to look at. I'll analyze those charts and we'll look at the option chain, see if there's any good plays there, okay? So, hey, Greg from New Zealand, Richard from Long Island. Man, people all over the place. So far, you get the distance award, Greg. Thanks for calling in. I have no idea what time it is in New Zealand. Probably about 12 hours difference. Must be early in the morning or something. Okay, so that's what we're going to cover today. And again, be thinking of a stock symbol if you got some that we can analyze and look at the option chains for them. So, of course, the disclaimer, this material is being presented for information, for education, for you. I'm not a financial advisor. I don't know your own situation. And so I'm not making recommendations for you. I'm teaching some basic information. I'm showing you how I trade. Okay, and if we look at charts and I offer my opinion, that's just what it is, my opinion. And you have to make your own decision about whether to act on that opinion, okay? 10:30 in the morning, you say, well, that's not too bad, Greg, not too bad. Okay, that's the disclaimer. So let's jump into it. How do options work? Okay. And again, type in questions as we go, please. Make it as interactive, make it as valuable for you as possible. Okay. So options, stock options. We'll use the term stock options. It really applies to stocks and ETFs, ETNs, other trading instruments. Okay. There's two basic types of options. There's calls and there's puts. Most people know that, right? But when you buy a call option, what you're really buying, you're not buying stock, right? You're buying the right. It's a contract. You have the right, but not the obligation to purchase the stock at a predetermined price anytime before the option expires. So you've purchased a right, a contractual right, but you haven't purchased any stock. You buy a put option. Similarly, you have the right, but not the obligation, and not the obligation is key here, to sell a stock. You get to sell stock that you don't even own at a predetermined price anytime before the expiration date. It's a contract between two parties. It's the contract writer and the contract buyer. Okay? The buyer has the right but not the obligation to exercise the contract and the buyer sell the shares. The contract writer, on the other hand, the person who writes the contract, who originates it, they have the obligation. They're on the hook. If the buyer exercises, they're on the hook. They have to buy or sell the shares at the predetermined price if the buyer exercises the contract. Okay, we're going to focus on American style options. There's other types out there. There's European and others. And just the quick difference is European or American options can be exercised at any point during the life from the time you buy it until its expiration date. European options and some others can only be exercised at the expiration date. That's a big difference. Okay, so we're just going to focus on American style options. Okay, so let's talk about call options. Go through some basics here. Suppose you have a reason to believe that you've got some chart analysis methodology, right? You have a reason to believe that a stock is going to go up. So you could just go buy some shares of the stock. That's easy. You can do that. Or you could buy a call option contract. Now, why would you consider buying a call option contract instead of the shares? Let's look at an example. And there's some good reasons for it, okay? So here's an example call option. This is Apple. Everybody likes looking at Apple. So here it is as of October 2014. And let's say at the end of October 2014, Apple's trading at about $100. You have a reason to believe, whatever your analysis technique is, you go, I think it's going to go to 120 by the end of the year. Okay. So wouldn't it be cool if you could buy Apple at $100 a share after it went to $120 a share, after you were right? That would be awesome, wouldn't it? Well, you can. And look, wow, you're a genius. It did, right? Apple went from 100 in October to 120 at the end of the year. And because you're an options trader and you understand how this works, you get to buy Apple at $100 a share. Woohoo! How is that possible? Well, it's possible because back in October, you bought a call option contract and it had a strike price of $100 a share, or $100. Strike price is the contracted price that you can buy the shares at, regardless of the fact that it's sitting there at 120. Okay, since the price went up to 120, that's a really good thing, isn't it? All right. Of course, this isn't free. No, there's no free lunches, right? So you have to buy the contract. You have to pay for that right to buy the $100, buy the stock at $100 in the future, and that's called the premium. So to buy a contract, you pay a premium, kind of like an insurance policy, right? The premium's the purchase. It's what it costs to purchase the call option, the right to buy shares at a predetermined price. And that does not last forever. The contract that you buy has an expiration date. And if the expiration date comes and goes, and you didn't exercise your contract, or if the price went down and there's no reason to exercise the contract, then your contract will expire. And if you do nothing with it, it will expire worthless. Okay? It will be worth zero after the expiration date. You'll have no rights. Okay? Welcome to the folks who are just joining. Don't worry if you missed anything. Don't stress out. We're going to send out a link for the recording and a copy of the PDF presentation, so you can definitely catch up if you like. So put option basics. They work just the exact opposite way, but it's worth walking through here. So let's say, suppose you have a reason to believe that a stock's going to go down. Right? So you could just sell some of the shares of the stock short. And here's an important point. And that's assuming you're not trading in a tax-deferred account in an IRA, because you can't sell stocks short in an IRA. The IRS does not allow you to sell short in your IRA. It's against their rules. Okay, but you could buy a put option contract if you think something's going down, and yes, you can even do that in an IRA because that's a long position. Even though you think the stock's going down, buying a put is a long position, and you can do that in a tax-deferred account. So that's pretty cool. So why would you consider buying it instead of just shorting the shares? Well, let's look at it here. Okay. So here it is, middle of July 2015. Apple's at 120. You think it's going to go down to $100 by the end of the summer. Wouldn't it be cool if you could sell it at $120 a share after it went down to 100? Well, you can. And of course, you're still a genius. Apple did go down below $100, went down to 95. That's awesome. And because because you've been to this class, this presentation, you know what's going on, and you get to sell it at 120 because you bought a put contract back in July. You bought a put option contract. You bought it with a strike price of 120, and of course you paid a premium for that. And of course there's an expiration date, just like there is on calls. Okay, so that's a really basic look at what option contracts are. And this is really the buy side of it. This is not the sell side of it. So we'll talk about that a little bit. Okay? We talk about controlling risk. But that's, any questions before we press forward here, just on that very, very basic look at options? Everybody with me? Everybody good? Am I still on? Am I still online? Can everybody hear me? It looks like all my meters are moving here. Yeah, everything's okay. Good, good. I did a webinar once, like a year ago, where I didn't realize I had lost my connection. No indication on the screen, and I kept talking for half an hour to my computer screen to nobody at all. It's awesome. Okay, we're still online here. We're still good. Awesome, good. Okay, let's keep moving. So let's talk about the power of options. We'll use those same examples and some of the profit potential that they provide. It's good stuff. And the power can be described in one word. It's leverage. Let's look at that example that we walked through. So in October, we said we thought Apple was going to go up to $120, right? So we bought one at a strike price for $100, right? That's the price we can buy the stock at if we choose. We have the right, but not the obligation. It had an expiration date of January, and we paid $1,000. That's the premium. Paid $1,000 for the right to buy Apple at $100 before January of 15. Okay, so we could have just bought the shares in October, and it would have cost us $10,000. So 100 shares times $100, $10,000 in capital tied up in the trade. Okay, and it would have been $20 per share times 100 shares in profit, $2,000. We made a 20% gain. So nothing wrong with that. That's a pretty good gain in a couple months. Nobody would complain about that. But what if we bought the call options, the December 15 strike price 100 call option? One contract would cost us $1,000, and that's a realistic price for Apple at that time. So we paid $1,000, and we made a $2,000 gain, right? And we had $1,000 profit because we spent $1,000, we made $2,000, subtract the cost there, and it's $1,000 profit. Okay, and that would be exercising the option, buying 100 shares at $100 and then selling at 120 immediately. $1,000 in profit, 100% gain. Okay, so for $1,000 you controlled, or you profited from the price movement of $10,000 worth of shares. $1,000 controlled $10,000 worth of stock. Okay, that's leverage. And a put option works exactly the same way, just except you're selling. Okay. So Greg's got a question. He has an option that he entered 2 weeks ago. Okay. Are you still typing? That's a good statement. I assume there's a question coming. All right. I'll give you a minute. Okay. So we only made $1,000 here, but we made 100% profit on our trade. And how much money do you have at risk? If you have $10,000 in Apple shares, how much do you have at risk? You got $10,000 in the market at risk, tied up. Here we've got $1,000 at risk in the market, tied up, that we can't use for other things, right? Big difference. All right. Okay, so remember that example we said here, you're going to you're going to exercise the contract, go buy the 100 shares at 100 and sell it immediately. But here's something really cool, right? If that's not good enough, right? If you bought that option contract and the price went the way you thought it would, you don't have to actually exercise it. You just sell the contract. Option contracts trade kind of like stocks. There's a market for them. They have a bid and an ask, and there are buyers and sellers. So if you paid $1,000 for it and Apple went up to $120 a share, that contract's going to be worth at least $2,000. That's called its intrinsic value. And then there will be some extrinsic value based on how much time is left on the contract and the underlying stock's volatility and a bunch of other complex math, but it's worth at least $2,000. That's its intrinsic value because you get to buy shares at 100 that are trading at 120. It has an absolute intrinsic value of $2,000, can't be lower than that, and you can just go sell it. You paid $1,000, sell it for $2,000, pocket the money and move on to the next trade. Super cool. So Greg has, he said he's got these contracts on Facebook with a July 15, 2016 expiration date. What happens when July 15 comes? If you're still holding the contracts, Greg, what happens is they're worth zero. You lost all of your money. So you need to either exercise or sell them before then. And the closer you get to that date, there's something called time decay. So the actual premium, the value, part of the extrinsic value of the contracts starts to drop off really fast towards the end of the contract. So I want to be careful about that. Okay, so good question. Okay, so you can just sell the contracts. Okay, and there's an important piece of terminology to be straight on. Okay, if you go buy contracts and you own them, you can sell them. If you don't own contracts and you sell them, that's called writing contracts. Okay, as we get into the risk portion here, that's super important to understand, and that's why on your brokerage system where you place orders, they will use these terms: buy to open, and then when you sell contracts, it's sell to close. And if you're writing contracts, it will be sell to open, right? So that you don't get confused on that sell terminology. Sell to open, or sell to open, buy to close. Okay. So that's important to know. So let's talk about the risk. Greg's asking me now, when would you suggest to sell Facebook? Let's look at the Facebook chart, okay, when we get to that section. It's coming up pretty soon here. We'll analyze Facebook. That's the answer, okay? The answer is always on the chart. The chart is reality, okay? So the risk of options. So, of course, there's no free lunch on Wall Street. And as powerful as options are, of course there's risks, right? Or it wouldn't be investing, it would be printing money. Okay. For writers of contracts, people who sell to open, right, who take on the obligation to deliver shares at a predetermined price, the risk is unlimited. How do you feel about unlimited risk? I don't like it. I have no need for unlimited risk. Now, I say unlimited, that's if they're doing what's called, if they're writing naked contracts, if they don't have the shares to deliver, if you exercise, okay? The risk is unlimited. When you go to place the order, your broker will remind you of that. In fact, the risk is so big that if there's not enough in your account, say you were the one who sold puts on Apple, and Apple drops like a rock. There's some bad news that comes out, and it drops from $100 to $50, right? You got to go buy Apple at 50 and sell it to the person withholding the contract at 100, however many you sold them. And if you don't have enough money in your brokerage account, you get this really annoying thing called a margin call, where your broker calls you up and says, hey, you're on the hook to deliver those shares to go buy them at 50 and sell them at 100, and there's not enough money in your account, you got like 48 hours before we start seizing assets to cover that obligation. That's no fun, right? That's annoying. So why take that? Why take that risk? Okay. For buyers, if you're a buyer of an option, you have the right but not the obligation. You're not on the hook for anything, right? It only extends to the premium that you paid for your contract. Now you can lose 100% of the premium, but we can control that, right? So say this this Apple call contract, right? We strike price 100. We paid $1,000 for it. Well, the absolute maximum, the most money we can lose is $1,000, what we paid. No more. Doesn't matter what the stock does. The absolute most amount of money we can lose is $1,000. And we can potentially double or triple our money. So that's a pretty good deal, huh? So if you thought the thing was going to go up and instead it went down and you did absolutely nothing, the contract would expire worthless out in January and you'd lose your $1,000. Now, you don't have to let it expire, right? You don't have to let it expire worthless. Even if the stock is going the wrong way and the price of the contract, the premium is going down, you can still sell it. So if you bought it for $1,000 and Apple just drops and now the premium is, it's only worth $500, well, you can go sell it for $500 and you only took a $500 loss as opposed to a $1,000 loss, right? And again, as it gets close to its expiration date, the extrinsic value of it begins to drop rapidly. That's called time decay, rapid time decay. And it's a risk you have to pay attention to. That's what I was talking about with Greg there, because he's got July 15 Facebook options. And we're in the last 30 days of a monthly contract is when it really starts to decay. So get to watch that. Okay, 2 options for writers of options. Those are obligated. Covered, so that's actually not as risky as writing naked options. Covered means they already own the shares and they have to deliver them to you if you exercise your option, right? And some people use that as a, say someone's got a big position in Apple and they think, for the next 6 months, it's not really going to do anything. It's going to stay there at 100, but I don't want to sell it. I'm a long-term buy and hold investor. So they'll start writing call contracts. And you give them your $1,000 and, lo and behold, end of the year, Apple's still sitting at 100. It did nothing. They get to keep your $1,000. Okay. And so they like to make money on the stock positions they own by writing covered calls. And their risk is if it goes up to 120, you exercise, they got to give you their stock. And they don't get to make the 20% gain on it that you did. They only got the $1,000, the premium you paid. So they're taking a risk too. But that's an opportunity risk. If they are naked, right, they're naked, right? And they could lose more money than they have and really be in trouble. And that's not a good place. That makes me have trouble sleeping, so I don't do it. So the other risk is, as a buyer, is the contract has a deadline. It's got an expiration date, and if you don't get what you want by the time it expires, if you don't do something, it'll be worthless. Roger's asking, can you reverse the trade? By reverse the trade, do you mean if you bought calls and the thing started going down, you can sell your calls and go buy puts? Sure, you can do that. Yeah, absolutely. Be careful. Don't get into a whipsaw, right? Buying options always starts with an analysis of the underlying asset. We're going to demonstrate this here. We're going to demonstrate this. So we don't buy options on their own, right? These are derivative instruments based on an underlying asset. So we go analyze the underlying asset first. But to just, buy calls and it turns around, head the other way, so you sell them and go buy puts, that's an invitation to be whipsawed, where you lose on both ends, right? David's asking, can you do a put credit spread in an IRA? Yeah, absolutely you can. You have to be qualified at your broker for the right level. Options have level 0, 1, 2, 3, 4, I believe is the range. And those define the activities that you're allowed to do. And most brokers call you up and give you a little quiz and make sure you understand what you're doing before they'll let you trade options in any account because of the risk, particularly in writing options. They don't want to make that margin call and you to go, huh? I didn't know that could happen, right? So they make sure you're qualified to trade, but that was a long answer to a short question, and yes. Okay. Again, there's this risk of the thing expiring, but you don't have to let it expire worthless. There's no reason to. Sell it for less. And the way I do that is I have a predetermined stop level on my stock charts that gets me out long before the thing will expire worthless. So I might take a loss, but it'll be a very small loss. I never let it go to zero. Okay. So how do you control risk when you're trading options? Okay. Well, one obvious step here, never write contracts. Then you never have to lose sleep worrying about that margin call. Remember that word, unlimited risk. Now, there are advanced option strategies. David was asking about a spread where you write one contract and you buy another at different points and they protect each other and stuff like that. Multi-legged option strategies, you know, iron condors, butterflies, you know, all kinds of strange winged creatures. You better know what you're doing. A lot of people trade spreads and winged creatures. You better know what you're doing, and you better, you know what the worst case is. You got to understand what's the worst thing that could happen to me. And if you don't understand that, the worst thing may happen, and you may be totally surprised. And that new car or house or vacation or retirement may be pushed out 5 or 10 years. So I like a very simple option strategy, and I know a lot of people do other more complicated ones. I've done them all, and here's what I figured out. Simple's better. Simple's better. I only buy calls and I buy puts. And guess what? I've been very profitable doing that. And I don't lose any sleep because I know exactly how much money I could lose. It's the premium I paid, period. No more, no less. Well, less. I can lose less, but no more for sure. Okay. I generally use a 2% rule. So if I only spend no more than 2% of my trading account on any one option trade. So $100,000 account, that means only spend $2,000 on the premium. So the Apple example, contracts for $1,000, I buy 2, total of $2,000. So if the absolute worst thing happens, right, we wake up in the morning and Apple went from 100 to 50, right, that contract is now worth 0, right? I've only lost 2% of my account. That's tolerable. I don't like it, but it's tolerable. I can recover from that in the next trade or two, right? If I lose 50% or 100% or 150% of my account, that's hard to recover from, if you ever can, okay? And again, I can sell it early. I can sell it early if the trade's going against me, if the underlying asset has hit my predetermined stop price. I get out and I get an even smaller loss. Lose 500, lose 1,000 instead of 2,000. I don't like that, but I can tolerate it. I can tolerate a handful of those, a string of those, and not be a major setback, right? And currently my win rate, my long-term win rate's about 70, 75%. So that means some are going to lose, and sometimes you get a couple in a row. But what makes me profitable is I win more than I lose, and my winners are much bigger than my losers, right? You can do that math in your head, right? If you win 75% of the time and your winners are bigger than your losers, you can't help but be profitable. You have to maintain those stats. You have to pick the right trades. You have to manage them well. But that's how it works. That's how we control risk on options. Don't have more in the trade than we're willing to lose, and understand exactly how much you could lose, what the absolute worst case is. Okay? So options are derivatives. It derives its value from something else. And stock options derive their value from the underlying asset, the stock. Okay? I never go into a trade, whether it's a put or a call, without knowing the exact entry price, the stop price that I will get out. And you can have a debate about whether you have stops orders in place or not. At least have it defined. And if it hits that stop, have the discipline to go close the trade so you don't lose any more. I have a target price and I have a time to the target. So with those values, then I can go choose the right option contract. the right appropriate contract to buy. How's that? So let's look at option chain. Okay, and this is where some people get a little fuzzy. Okay, so I have some slides on that, but why do slides when we got live markets here? Okay, let's look at some real stocks, some real option chains. So here's Citibank, and I am actually short this right now with puts. I use a combination of Dow theory and Elliott wave to analyze charts, and it's worked really well for me. And so it may look a little busy here, but what's going on is we've got an Elliott wave 1 and 2. Let me get my pen out to make it easy. Sometimes it's hard to follow the cursor. I'll draw my pen here, okay? Should have had this ready to go. There's my little pen tool. Okay, I'll draw this for you. Wave 1, 2, 3. 3 is easy to spot because it's the biggest, most dramatic price move on the chart, and my indicators here help me. They put a little pink dot, and that helps me know it's wave 3. Now here comes wave 4. Wave 4, A, B, C, right into a Fibonacci retracement zone from 61.8 to 38.2. That's a perfect wave 4. It retraced that percent from here, and now it's shown evidence that it's going to go down. It's going a lower low, a lower high, new low. So that I've used my Fibonacci extension lines to project where this might go to in wave 5, and the high probability target zone, since we've had 4 waves already follow a very well-known pattern, high probability the 5th wave is going to do its thing too, and its thing is to go down here 61.8 to 100% extension of that wave to 34.32 to 25.89. Okay, so I've got my entry price, which is this light blue cyan colored line. I've got my stop price right here. If price goes up to here, my theory is invalid. Trade's over, I'm getting out, and I got my target down here at this dashed green line. Okay, 34.32. Remember that number. Now, how long did wave 3 take? Wave 3 started in early November, and it ended in mid-February. So November, December, January, February, 4 months-ish. So wave 5 is going to be probably roughly about that same amount of time. Okay, say 4 months. So let's go look at an option chain then. Citibank, it's sitting right at about 42. Our target's 34. Let's remember those numbers, okay? So here's an option chain for Citibank. And there's just all kinds of cool data here. So you come in and it shows you, this is Citibank. It's got the name on here somewhere. Here it is, Citigroup Incorporated, simple C, last price. And here's the various expiration dates that are available. July, August, September. So there's the July 15th that we were talking about with Roger and Facebook, right? Okay, that's the latest contract. Now I said about 4 months for wave 3. So we're here we are in June. So July, August, September, November. Boy, I don't want to be any closer than December because I don't want to get into that last 30 days of this thing. But let's look at December. Okay, so here's the option chain for December. So all these contracts have a December expiration date, December 16th, 2016. And they're for 100 contracts. Every one here is for 100 contracts. That's the typical deal, 100 shares. Okay, the middle here is the strike price. That's the price that you either get to buy or sell at. On the right, you can see these are puts. Over here, these are calls. So we're thinking Citi is going down, so we definitely want to be buying puts, right? And so my rules for buying these is I want to be in the money. I want to have some intrinsic value, and I want to have a high delta value. Delta is the amount that the price of the option contract is going to change with a $1 change in the underlying value. So if Citibank goes down $1, the price of this put contract right here, here's a delta of 0.65. It'll go up by 65 cents. Okay, so we want in the money, high delta, and we want to pay as little as possible for the doggone thing, right? These are the prices. This is a bid and an ask, just like on a stock. And they're per share, so these are actually 100. So this is the bid, the ask for the 47.50 December put contract for Citibank. They want $635 per contract. Now the next increment, $50 strike price, is $830. That's a $200 difference. So in this particular option chain, I like this one. I like the delta to be a little bit higher, but look at that jump. Okay. And the other thing I look at is the open interest. I want to make sure there's sufficient volume being traded. So this has 2,364 contracts out there that people have bought and are holding. So that's pretty good depth. Okay. So 635 bucks. So I like that there. That's pretty good. So what if I buy that? Let's say we were trading a $50,000 account. And so it's 635 bucks. We might be able to get a little better, but let's just say it's 635. Okay. Well, if I have a $50,000 account, Dean said 2% of that, so that's $1,000. So I can only risk $1,000 on the trade, but I'm also pretty disciplined, and I've got my stop that I can get out before it hits my price. So I can buy two. That'll be $1,200. Okay, and that's a legitimate strategy, and I teach that, how to do that. So 1,200 bucks, right? I'm gonna have 1,200 bucks tied up in this trade. Okay, I can tolerate, even if that goes to zero, I can tolerate that. That's rounding. That's at my 2% level. Okay, how much can I make? How much can I make? And I'm using TradeStation here, and they got a pretty cool modeling tool. So I just move the cursor down here to, now watch up here in the corner, if you can see it on your screen, if it's not too small. I'm going to move the price down to 34, about 34, I think the target was. We're going to use the low end, going to be conservative. And it says, if the price goes down to 34, I will make a $1,390 profit. Well, that's pretty good, right? Because I only spent $1,200, and if I make a $1,390 profit, that's over 100% profit. I'll take that, right? And the most I can lose is the $1,200, and I'm going to get out way before then. In fact, let's look. My stop is at 45.84. So if this thing goes to 45.84, we don't have to guess. We have the data, right? If it goes to 45.84 right there, it's going to be a $350 loss. As of today, and then farther out in time, it's going to be bigger. So I can make $1,300 profit if I'm right. It goes down and hits the target. If I'm wrong and it hits the stop, I'm going to lose $400 or $500, and I'm going to go sell that thing. That's a good reward to risk ratio. I'm taking a risk of losing, say, $500 versus the potential to make $1,300. I'm in. I'm in. I like those. I like those ratios. So Roger says, can you use stops just like trading stop? You can, Roger. The trick is you have to project what the price of the contract is going to be when the underlying asset hits the stop price. And there's a way to do that, and I teach that. Okay. So here's Richard's got a question. Let me read it. Okay. I'll try and read fast. Yeah, so Richard's saying he's got a big position. He's been selling out of the money calls against it, just like I talked about earlier as a strategy. He goes, but I can't afford to have it called. I can't afford to have anybody exercise. I don't want to give him the shares. That's what you're signing up for, Richard. When you write those contracts, you're signing up that if you get assigned, that you got to deliver them, right? Can you instruct the broker to cover your position? He'll be happy to go buy new shares for you if that's what you want. That's very expensive. Yeah, that's a little beyond the scope of this discussion because you're doing a little more advanced strategy, Richard, but I hope my answer was helpful to you. you're selling the right, and you're on the hook to deliver those shares if you get assigned. And I'm not sure you'd want to go buy new positions to cover, because that's going to cost you a lot of money. So, okay, where were we? We're in a couple positions here, talking about charts. I don't know why that doesn't work. We're short. We're really short Citibank. We're happy we're short it, right? We're in profit on this one. Being in profit is a good thing. Okay. There. We're long U.S. Steel, and we're deep in profit on this one. Super happy with that. So we had somebody wanted to look at Facebook. Let's look at that. So Facebook is in a big long uptrend, not a smooth orderly uptrend, a very volatile uptrend, but there's no debating the uptrend here, is there? It looks like it is getting very mature. This trend is getting very mature. Where did it start? It started way back here. I've already analyzed this one. It started, there's wave one, there's wave two. It started a long time ago. And you see at the end of this trend, a couple interesting things happening is this oscillator down here. See how we're getting growing momentum? It was a little bit of red, now it's more red. So each move down is gaining momentum. And using Dow theory, we can zoom this in a little bit. Dow theory says that a trend has changed. An uptrend is higher highs, higher lows, higher highs, higher lows. The trend changes when you get a lower high, doesn't put in a new high, and a new low, and that has happened. So there's a good probability this trend has changed. And it could be heading down for a correction. And that correction would be, I have to update this because it moved up since the last time I looked at it. That correction would be to about there. Correction would be down to 90.68 to 72.31. If it takes out this low at 106.05, that's a pretty key support level. You could let it take that out. That's a pretty conservative entry. It'd be a very aggressive to go in now. So that's my thought on Facebook. Cameron asked about BPT. BPT. Let's take a look. Well, that's just about the opposite, isn't it? Prudhoe Bay Royalty. That must be an energy-related stock. Okay. So you look at this chart, and some people go, "Oh, that's awful. That's terrible." Look at that downtrend. I look at a chart like this, I get a little bit excited because barring, for uptrends, you can say uptrends always correct down at some point, right? You don't know when always. You can tell when it happened, but you don't know when it's going to happen. But uptrends always correct. Most downtrends also correct up, even if it is nothing more than a short covering rally, right? Most downtrends correct up, unless the thing just goes out of business, which could happen. So here's my Fibonacci, my wave 1, 2. So if we get a wave 4, there's a big long ways for this to recover to, okay? Up into 44 to 65. Now that won't just happen instantly. It'll take time. This is a pretty orderly chart, but we do see growing momentum down here in the oscillator, right? Momentum's growing. I would like to see probably a new high, something like take this out right here with a little bit of authority, not just a couple ticks, but blow through that, and that might be a decent entry. Get in at 1743, double your money up here into the zone. That's pretty nice. So BBT, so it's at 1588. We're saying get in at 1743. Let's see if it's kind of light volume. It only traded 100,000 shares today, but let's see if they got an option market. This is an option webinar. Let's stay focused. Turn that off. Okay, BPT does have an option market. Let's look at it the December, But look here, the open interest on the calls is non-existent. Oh, wait, no. It's there, pretty much single digits. So not bad. It's double digits. Not bad. I'd watch that carefully. We said the entry was 1743, so we want to let it happen first, and we're going to come look at these in-the-money calls and see what the pricing and make sure there's some open interest on those to trade them. But that one could be really, really interesting, and that was for Cameron. Okay, let's look at SGY for you. You type that one in. Same, it's the exact same thing. Be careful about trading. This one's got an F, which means it may be delisted. It's got some kind of issue with the brokerage, with the exchange. Okay, so be careful. Much larger volume. I like that about it. Way larger volume. What you don't want to do is take the exact trade twice, because if one fails, they're probably both going to fail. So same sector, same chart pattern, they're going to do the same thing. So don't take two and think you're diversifying. You got the same trade at twice the risk of one. So be careful. And SGY and the other one are the same trade. Okay. Rajesh wants to look at UNG. Well, I want to look at UNG too. We're actually long this right now. We've been long since 706, and it's sitting here at $8, and it's got a long way to go, 1382. So we traded this with an option, but that was a few weeks ago, so it's going to be a little bit different analysis now. So let's look at it. So how about if I show you? So I think we got in with the October, but it's been almost a month since we got in. I think we'd be pushing a little bit on October. So let's look at the January. That's the monthly contract. Yeah. So UNG's at $8. So we want to be call contract in the money. We want a high delta here. So there's 71.83. That isn't that big of a price. So to get a delta of 83, you can buy these for $2.36, and there's massive open interest. So that'd be a nice one right there. The UNG January 17 strike price 6 for $236 a contract. That's a pretty nice one. My opinion. You know, don't go take the trade just because Dean said so in the webinar. Make sure it makes sense for you. I'm not a financial advisor, but that's the one I would buy. All right. Cameron's asking, what's my minimum open interest? It's really relative to the volume of the stock and how many shares I am trading, Cameron. So, you know, if it's in single digits, that's a little worrisome. What we really want is to know that when I want to sell that thing, I can sell it, that I'm not going to be stuck with it, right? Even though the price is moving against me and I want to get out with a smaller loss, right? If there's plenty of open interest, you can get out. If there's, you know, if you're the only one, right, you got 3 contracts and you're it, there's nobody to sell it to. And that might just be a problem. So relative, you know, I don't want to be more than, say, 10% of the open interest. So there's a guideline for you. How's that? Okay. So what are we at? We got about 10 minutes left. I want to, you know, stick under an hour here. Rajesh is asking, what's your checklist priority to decide which strike price open? Yeah, so I ran through it really fast, and I know. So I want high delta. I also look at the ratio of intrinsic to extrinsic value, and I want a high open interest, right? And I want the best price possible. So I take all that together and try and pick out the best absolute contract, best premium, best delta, best open interest, and make my choice. I'm always buying in the money and high delta. Yes, I always buy in the money. Out of the money, the delta is too low. Delta is too low usually. Now I say sometimes I will buy at the money if there's a big move planned. Yeah. Okay. But you're a great straight man there, Rajesh, because I'm going to now talk about some next steps here. So what are some next steps you could take here? So if you feel comfortable, based on what you know here, try analyzing stock charts, whatever method you use, and choosing some option contracts. Give it a try. Man, I sure advise doing it in sim first. Make sure you do it in sim or demo mode first. Just get used to placing option orders if you haven't done it. You don't want to make a mistake, go the wrong way. Man, I've even done that after I knew what I was doing. Look at the option chain and go buy a put instead of a call. That's not happy. But just, get familiar. Do it in sim. Make sure you can do it. Okay, do it in sim, do it in demo. Another thing you can do is subscribe to my stock picking service, right? I include option contract details on about 80% of my stock picks right now. And I've got a course, and I got a screaming deal on this course. You want to hang on and hear about this. I'm going to make you an offer you're not going to want to refuse. You're going to hear something no other educator that I've heard of does. Okay, stock pick subscription. So I make 1 to 2 stock picks every week, and I publish them. These are stocks I'm buying in my own account with my own money. So these aren't just, I'm just dreaming them up and you're on your own. I'm in there with you, man. And these are the best of the best picks. I include option contracts on about, it's really 80%. And I give updates every week. I give a narrative on how the trade's playing out, just like I showed you on my charts. I do a video and go, here's what's going on with the trade. I move my stop. I give you updates on stop loss, on scaling out, locking in profit, all that kind of stuff. And if something happens midweek, I'll shoot out an email, so hey, we're going to move a stop, we're going to do this. And here's my 4-year track record, right? I'm pretty consistent, doing pretty good here. You can see 2013, 57%, 14, 37%. Market got tougher and tougher, hasn't it? Last year, 28%. This year, we're up 15%, even though the market, man, the market's been channeling, doing nothing since March. Here we are in mid-June, right? So I feel pretty good about these results, given that the market's not doing anything. We're squeezing out a little bit of profit in some sectors that are moving, and it's going to move. Here's the details I give, the company, the ticker, the price range that we're either going to sell it or buy it in, what stop loss is, what the target is. I give you a little calculator to figure out your risk control, how many shares to buy. It's all down here. It's pretty cool. And then I give contract specs, like on, this one I publish is a real trade. Hey, it's the April 2016 put, strike price 110, and don't pay more than $8.25 in premium. So I'll give you all that detail in my stock pick service. So if you're interested in that special offer, you can try those for 10 days. Take a 10-day trial, so that'll be across 2 weekends. When I publish, you'll get 2 weeks worth of picks. And if you don't like it, you get 100% of your money back. And so Lynn, my team member, is on the line here. And look at that. She's already done it. She already posted the link. She is on it. Okay, so there's a link for the stock pick trial. Again, 10 days, $7. And after that, I'll give you a discount. List price is $127. You only have to pay $97 per month. After, and you can cancel that at any time. You're not locked into any commitment there. And you get a free one-on-one phone consultation with me if you'd like it. I've got some great picks right now that still have good entries. Showed you a couple of them. There's others, and new ones coming every week. So you might be interested in that. That's one way thing, I'll give you stock picks. Okay. So that's one next step. The other idea, I've got a pretty new stock option course that I developed late last year, and it goes a lot deeper than what we covered here, and I teach you everything you need to know to trade the exact same strategy I trade for my stock options. And it includes over 8 hours teaching videos. It's got PDFs you can download. There's some reading material. There's some worksheets and all kinds of stuff. Cameron, yes, I do have a trading room. There's the link for the stock option course, and maybe Lynn could find the trading room link as well. Okay, 8 hours videos. You get PDFs, download and study. You get worksheets to work on. email. If you have any questions, you can email me, and you can also schedule a one-on-one time with me. We get on the phone and talk through, share screens if you're got questions. You're going to learn how to choose the right option contract, the exact method I use, more detail on the Greeks, how to use them to your advantage, how to place and manage contracts. We've got a recorded live trading session where we actually place option orders and show how to manage them. Advanced risk management strategies, because there's some more things we can do so we can take bigger position sizes without increasing our risk, and a lot more. And here's the screaming offer, right? First, you get 25% off. So the list price $497, you can get it for $379 if you order it now. And Lynn's posted the link. And here's the deal that I don't think too many other people do. I guarantee you're going to make the cost of the course back by the end of the year. And if you don't, I'll refund your money. I will give you option picks every week as you're taking the course, and I guarantee that by the end of the year, you will have made back your $379 at least. And if you haven't, I'll give you a refund. You don't even have to ask. I'm pretty confident. When I send this out, there'll be a link to read the testimonies from the other students. Okay, people who have taken the course already, they loved it. The feedback from the people who took that course was awesome. I was really humbled because I did my best to deliver a great course, but I was surprised at how much they liked it. Okay, so that's really the material I wanted to cover. I'm more than happy to hang out here and answer any questions that you have. We will send out a recording. We will send out the PDF and the links for these offers if you want to think about it. But that's a pretty good deal. Take a course, and a course that guarantees you will make it back in profit. If you take the trades, I will give you the trades as you're going through and learning about them. And I guarantee you'll make back the cost of the course, or I will refund your money. So I think that's a pretty good offer. I haven't heard too many other people kind of stepping up behind their product that way. Any questions for you that you have? I'm going to stop and breathe, take a drink of coffee, and see if you have any questions coming in. Greg's asking, TradeStation 9.5, how much does it cost? Depends on your account size, Greg. I think the basic platform fee is like $50 a month. And then there's different features, and you got to pay for different data feeds, which are pretty cheap, right? If you're just doing stocks, the data feed's a couple bucks. If you're going to do futures, it's $20. If you want to use radar screen and your account is under a certain minimum, or your trading activity is under a certain minimum, they have a schedule, and it depends on your volume of trading and your account size. But it's pretty reasonable. I've been with TradeStation for years, and I like it. I've also got Ninja. I like Ninja for day trading. I like TradeStation for stocks and options and all that stuff. So that was a long answer to your question, Greg. Other questions coming in? Happy to field them. Going once, going twice. Well, it looks like we pretty well covered the questions. We had a lot of good interaction during the webinar. Lynn's posting some other links here too. We do have a free newsletter if you're interested. You can sign up. I do market analysis. Yeah. There's a live trading room. Cameron, you asked about that, so Lynn's posted the live trading room link there. Okay, Rajesh, would you consider covered call strategies in a future course? Yeah, I'll consider it, Rajesh. Right now, we're doing so well with keeping it simple that I'm not sure, I'm having a hard time justifying it. But if I convince myself there is a good reason, I'll consider it, absolutely. We're never done learning. We're never done creating courses and stuff. I'm learning, and I love teaching other people what I learn. Cameron says, can I touch on stock screening? Yeah, I do sector analysis, Cameron. So like I said, the S&P 500 is stuck. Absolutely stuck in a range right now. It may be getting ready to pop out of it, by the way. So when I say that, the S&P 500, I've defined this channel, these purple lines. So from late February, actually, to now, S&P 500 is traded within these purple lines in a very narrow range, 95 points. So I don't want to trade, in terms of screening, answering your question, Cameron, I don't want to trade stocks that are pretty much married to and moving with this index right now because they're going nowhere. So I'm going to go look at sectors that are moving. I'm going to go look at oil, and I'm going to go look at banking and minerals and mining because those sectors are screaming. And then I drill down within those sectors and find setups, good candidates. You know, I got some good screening techniques and tools that I cover in a separate class. But, you know, no matter, tools help us, but at the end of the day, you still got to look at a lot of charts, and you still got to have a good method for analyzing them. KJ's asking, never done lists that say I want to buy a call. How deep in the money do I go? How do I know it's the right price? There's an art to it, KJ. There's an art to it because you can go, you know, the deeper you go, the more expensive the options are. Deeper you go, the higher the premium you're going to pay. Let's look at this example here. This is UNG. So we can go really deep in the money. Here, and the premiums go from 236 where we're at up to 735, right? More than triple. So we can get crazy and just pay way too much. So in terms of picking the absolute right best one, there's quite a bit to it, and I go through that in the course, KJ. So you know, it's not like I'm not going to tell you got to buy the course, but there's not a simple answer, and I walk through it, and I think there's some material that builds up to that helps you understand it. It's how the Greek values work together, so that when you understand that, then the answer about how to pick the right contract will actually start to make better sense, and you can do it on your own. So take the class, KJ. I think you'll like it, and I'll give you picks. I guarantee you'll make back the price of the course, or I will refund your money. Yeah, I think that's a one-dimensional thing. KJ says he's been told go with the highest open interest. I think that's a one-dimensional view of it. I think there's a better way to approach that that's a little more refined and can get you better results, in my opinion. The go with the highest interest, what I believe that's saying is, you know, follow the money, that the crowd knows what they're doing and just do what everybody else is doing. I haven't found that to be true in trading, right? So that's my answer. Good questions. Good questions. I'll see if anybody else is typing. Hey, KJ said, thanks, Dean. You're a great teacher. Well, it's fun to be here. I enjoy doing this. I really like teaching people what I know and how to be successful at trading. So thanks for being here. Thanks for the comment. Yeah. All right. Going once, going twice. Hey, Cameron, you are welcome. You are absolutely welcome. So that, I think we're going to go ahead and wind it down. We're 4 minutes over. Hey, Rajesh, you're welcome. You made it great. Everybody made it great with your comments, questions. Okay. Well, hey, trade safe. Going forward, you know, make sure you use risk control. That's the key thing. You got to have a winning system, but controlling your risk is so important. So do that. And hope to see you in a future webinar. Hope to see you in the course, and you sign up and we can talk. Be happy to work with you one-on-one if you take the course and answer any questions you have, help you get successful. That's what we want. We want to see you be successful and tell others about it. Okay. All right. Have a good evening wherever you're at. Morning for the gentleman in New Zealand. Have a good day. All right. Take care, and we will catch you on the next one. Bye.